G'day, James. How are you, mate?
Good, how are you?
I live in the guru dream, my friend.
Very good, very good.
First time you and I have actually crossed paths, so really looking forward to this discussion.
It is
Incorp,
indeed. Yeah, absolutely.
uh, yeah, Incorp's been part of our trusted network for some time as we work broadly across industry to be able to highlight the best of tools and services for tech partners and specifically from startups to MSPs and everything in between. And look,
Yeah.
we've titled this session for financial leaders for founders
Mm.
and the skills that separate surviving and scaling organizations. But tell us a little bit about yourself, James, your background, and what brings you to today's conversation.
Yeah, my background has been in tax pretty much since my leaving of university back way back when now, over 20 years ago. So have been in the public accounting space for that time, been through a few mid-tier accounting firms and now joined a bit of a larger mid-tier accounting firm in Incorp, but been specializing in business services and tax for the duration of my career over 20 years now, and really focusing in on that kind of either established family businesses or businesses that are looking to get started. More recently, been involved through our government incentives department a lot more of the startup space. So we've got a government incentives department that deal with a lot with kind of your tech and biotech startups. And I've also started attending an incubator through the Wollongong Uni called the Accelerate. So they have me sit in their offices once a month, and I can help startups with the general questions and things like that, which has been fruitful. So it's been an interesting journey over the last couple of years getting into that tech and startup space. It's been great.
Awesome. It's perhaps a conversation for another day, but my business partner and I were talking just recently around the value that we're trying to bring is really lift up the entire industry in the tech space, and whether we should chase government grants ourselves. And so, perhaps a conversation for another day, given we are driving operational excellence to a broad set of organisations. But tell us more about it. So, can you give me like you work with founders and startups and SMEs? Can you give him a bit more of a practical example of how you would support those organisations in their journey?
Yeah, so it really depends on their life cycle, and it depends on what their needs are at the time. In an ideal world, we're with them from inception, so we can help them through the life cycle from day dot and put them in the right track. From a founders and startup perspective, it really kind of starts from your short, medium, and long term goals, understanding what they're trying to build over what time frame, and putting the right. I suppose the first thing is putting the right structures in place to allow them to grow in the right way, to not only have the flexibility when you're starting up to make decisions and pivot when you need to, but also having the right things there for when you do scale and then potentially exit down the track, that structure is still fit for purpose. So the first thing we really do is understand not just the business, but also the client, what they're trying to achieve in their journey, and making sure that they're set up the right way. And then we scaffold around them by putting the right things in place, and really starting them on their education journey about what it is to run a business, because they're usually technocrats from the start. They're usually very heavily invested in one very specific area, and they're experts in that field. But when it comes to the accountancy and finance side of things, they might have a little bit of knowledge, they might have no knowledge, but they certainly need some scaffolding to make sure that they navigate that really important first stage to make sure that they're set up right.
So what happens if they don't do that? What do you have any clients that come to you that have been in operations for many years and still kind of need that help? Is the
Absolutely, yeah.
intervention too
There are,
late or
yeah, no, it's certainly never too late to have a look at it and make changes that can assist going into the future. So we've come across businesses that have been set up for a number of years. They're still probably in scale up phase, not startup phase, but definitely still scaling, and they have certain structures in place. But there's a number of different levers that we can pull to restructure them, whether that's from a corporate restructuring perspective or restructure their processes, their accounting systems, etc., to give them what they need. There's obviously a gap in their business that come to us for help with. So that there's certainly things that we can do to assist them in that space, whether it be, is your structure fit for purpose? Do you have the right reporting? Do you have the right platforms? Do you have the right people? We can look at all those
Hmm.
various things to address the problem that's current for them, and then put them on the right path. Yeah.
There's a lot of accounting firms, right? Every town, every CBD has plenty of accounting
Lots of.
organizations. Obviously, already in this conversation, people can tell that you're specifically focused on the industry. What is that your key differentiator in this space? How would you articulate what the value that you, Incorp and yourself are bringing that's different from a average accountant?
So the real difference that we can bring is having more of that, I suppose, Southeast Asian footprint. We're not just a local accounting firm in Sydney. We're Australia
Mhm.
wide, and we're kind of heavily Southeast Asia based. So we have head offices in Singapore, Hong Kong, Malaysia, etc. And what that allows us, being a slightly larger firm, it really gives us some leverage to help our clients, not just locally in Sydney, but also leverage off expertise around the globe to either access markets or access different structures that might not be purely local. If they're looking to expand into other jurisdictions, we can help them with that. And we've really, really invested as Incorp, backed by Sentium, to really use technology to amplify us as advisors. We have some really great value creation at our head office level that allows us to really bring something a bit extra that a normal accounting firm probably couldn't.
Yeah, that's awesome. James, you're working with a lot of these, yeah, startup organizations, SMEs, founder-led organizations. Are there common trends? Are there common things that you solve for that often help partners scale in a better way, obviously
Yeah,
for
well,
yourself?
if we're really drilling into that kind of scalability, the biggest thing with scaling is usually your capital structures, because scaling usually costs money, and how they're planning on doing that. Usually, someone's trying to commercialize an idea. They've obviously got a little bit of backing from either family, friends, or themselves to get it to a certain level, and it will naturally reach a point where they're needing to either raise capital via investors or debt, or whether they're looking to take advantage of some of those concessions that we talked about before, like the R&D tax concession, which can really stretch a business's dollar just that little bit further by getting those R&D tax credits back. That can really help a business not dilute too much. That's usually one of the big things we see, or pitfalls that we see. Someone's got a great idea, they're looking to go to market, and they go out to investors, and they put too much equity on the table up front. They say, okay, I'm going to give away less than 50% because they want to maintain control, but they give away a percentage stake in that business at a valuation that might be either too low or too, I suppose, pessimistic, for want of a better word. And at the end of the day, they get down the track and find that they've given away a bit too much, and they probably could have funded that a bit better by off their own bats, rather than going to market too early trying to find that extra funding to get it up and running. So one of the things we look at is, are you taking advantage of all the incentives that are available to you so you don't have to go to market and take a dilution? If you are looking at investors coming in, are there ways we can structure that so we don't have to give too much away up front? Are there things that we can do around maybe options or other mechanisms whereby you're not giving away that equity up front, so you can, one, maintain control, but also maintain as much ownership to get
Mm.
that exit at the end of the day. So there are a number of different levers we can pull to kind of make sure that they're realizing as much value as they can down the track, while also getting access to enough capital. And there might be a portion of debt in there as well, depending on um, how much money they need and what their risk appetite is. So there's a number of different things. Yeah.
I'm so curious on this. Like, if it's a brand new organization, someone has an idea, potentially they've got a tech background, to your point, right? So they've got the ability to build that value themselves. They can do the development
Mm.
themselves. How are you even remotely trying to understand the valuation of a business to be even begin that conversation around getting investors in when you're kind of pre-cash and you're just an idea?
It's extremely hard, and this really comes down to, I suppose, your budgeting, your forecasting, your modeling more than anything else. So if you're going to an investor or a suite of investors with
Mm.
a valuation, having that really robust forecasts, those really robust cash flows, budgets, everything like that to back up the valuation. Because as you say, it's all blue sky, but you need to be able to have a deck there that is not just, I suppose, some very high level numbers. You need to be able to have the conviction that I've got models that back up where this valuation is pointing us to. So part of going to raise capital or getting a value, we have registered valuers in our business as well. And so we can, I suppose, put these valuations to the test, for want of a better word. We can make sure that they do stack up technically. So yeah, it's numbers for one, but especially if you're really really green, it's also selling a bit of a vision as well, because you you can have a robust model, but there's always a bit of blue sky and a bit of kind of
Mm.
it's that, I suppose, the secret sauce that you can't really put a number to, that, or a gap in the market you've identified that's hard to put a number to. But at the end of the day, every assumption, every bit of I suppose insider knowledge, or every bit of confidence can really really be, I suppose, boiled down to a number and a future revenue number at the end of the day.
Mm.
I've
Yeah.
come across businesses before where they've kind of got, they're in startup mode, they're pre-cash, they're generating all these kind of, they're they've got heaps of kind of cross-selling going on. They've got endorsements. They've got kind of heaps of these things locked in with kind of partnerships, and they're ready to go to market. And I say, okay, that's all fantastic. But how are those partnerships and how are those relationships going to translate, one, into revenue?
Mhm.
How is that revenue going to turn into profit at the end of the day? So it really, really puts it back in their court to say, okay, what is that relationship, or what is that collaboration, or what is that going to actually equate to in dollars back into this business at the end of the day? Because if I've done a collaboration, a marketing collaboration with one of the larger businesses, and they're looking to cross brand or something like that, how is that going to translate into sales? So we can put a number to that. How much is that going to cost me? What's my cog, and what's the profit at the end of the day? So it's really about drilling down into not just selling on blue sky, but having some numbers to back up those things as well. That really drives your valuation and gives investors confidence in your valuation as well.
Mm. Okay. Interesting. Earlier, James, you were talking about all fancy finance terms, working capital, cash flow management, performance drivers. When you're with a new organization and you're helping them build that structure, where are the moments where they actually, the penny drops and they realize, there's key things that they need to do or take care of that's really going to make a difference in the long run?
The biggest one you mentioned, working capital, is always an interesting one, because usually in startup phase, you're usually reinvesting a lot of your money back into the business. So if you look at a profit and loss, you've obviously got, if you're in revenue stage, you've got revenue, cogs, fixed costs, and profit falls out the bottom. And you think,
Hmm.
fantastic profit, it's mine. I can use it to do with whatever I choose. But if you're then reinvesting that profit back into further developments, new products, etc., that cash is essentially already spent. And then
Mm.
you go down the track and you've got wages to pay, tax to pay, suppliers to pay. If you've reinvested too heavily into your future development, you might find yourself in a bit of a cash crunch where you've got pre-baked liabilities that are there that need to be paid, but you've already pulled the trigger on all this spending on new inventory, new tech, new capex, and you haven't really mapped out those cash flows really well. So at the start, in startup phase, management of cash flow is the number one priority, because you don't want to get to a point a few months down the track where you find, oh, I've I've hit a cash crunch, and I need to go and find debt or some other source of funding to try and plug the gap while the next tranche of monies roll in. So control of cash flow is paramount when you're in that startup stage.
Yeah, that's really insightful. And you've been talking about, these pivotal moments, I guess, in a business's life cycle, whether it's capital raises or exits or restructuring. What are some of the kind of key challenges in those areas that your clients often face?
Yeah, key challenges, break it down to the various ones. So in terms of exit, key challenges are often value expectations more than not. So the client will have their own internal evaluations prepared, and they go to market and they find they don't meet. So bridging the gap between those expectations is what the market will pay is one of them. Restructures along the way is also very important. So you might start off with an existing structure that is, I suppose, lower cost to maintain, but might not necessarily give you the best outcome down the track. So if you've got your simple kind of PTI limited company and yourself as an individual shareholder and off you run because you want to keep it fairly lean, you don't want to spend too much money on with compliance costs, etc. As a business grows and as you become more sophisticated, you might want to insert, say, a discretionary trust between the company and your individual for asset protection and other various reasons. There are levers we can pull to get that change of structure within there. There are various concessions within the Tax Act to allow us to do that. So, depending on the size of the business, we can certainly assist clients getting their structure right once they've kind of gotten to a point where they feel they need to have those extra levels within the business. And similarly, at the top line, you might have a trading company that you want to try and split into various components. You might have developed various silos, product lines that you want to split to. One product line might be high risk, one might be low, and you want to make sure that they're separated so we don't have a potential contamination between the two. So again, looking at structuring options to make sure that they're split out, and also making sure that those structures give you access to what you need. So usually, if you're looking to again, back to the R&D incentive, if you're looking to access those concessions, it has to be through a PTI limited company. If you're an individual
Hmm.
or a trust or a partnership, you don't get access to those things. So making sure that you've got the right structure there is really important, and we can certainly assist clients in making sure that that's there.
I just thought on the structuring piece, yeah, or hopefully in a scenario where I've started my business and I'm starting to grow, and there's always going to be growing pains right across the business and learning as we develop our product and solutions. Are there key moments that people should be thinking about that should trigger discussions around structuring? Like, how do you know when your current structure is outdated or outgrown?
You'll probably start to feel it in a number of ways. You'll either find that the business is starting to get to a point where it's either at that scaling part of the life cycle where it's needing to raise capital. And say if you've got not just yourself but other parties involved, there might be various interests, there might be interests that are completely at ends, and to allow someone to have the flexibility to control their own world and not be beholden to their business partner or other
Mhm,
co-investors is really important. So usually we find that if the capital structure is no longer suitable for what they're trying to do is usually one of the trigger points. If they're looking to, I suppose, rapidly expand, so if they're going either outside of their normal kind of market, so whether that be locally outside of your state or outside of your city, if you're looking to grow into various jurisdictions where there are different compliance requirements or different needs or different risks you're looking to mitigate, that's another one. And usually, it's usually at the I suppose early to mid life cycle. That's usually where those things come to the fore. You've probably set up your initial structure. You've got it to a point where you are looking to scale it, and that's usually the point where if you're looking to raise funds through, especially through equity or through debt, that will usually be a trigger point for you to review that structure to make sure you're as attractive as possible to get those funds.
that's interesting. One of the things that we see, it's a very consistent theme we see in the tech industry, is a lot of organizations tend to get to around $4 to $5 million of revenue. They've at the level where they've got an owner or director of the business and a single leadership team, and they get stuck.
Yes.
And they don't know how to push beyond that to get to many of them are, say to me, we want to get to 10 million, but we've been at this plateau for a very long time. Do you see that? And if you do, what kind of what are some of the, I guess, the trends that you're seeing that causes that outcome?
Usually, if you get to that scale, and it's usually with single owner and single director style of businesses, they're usually the only person in control. They're the only person that's making the decisions. To to scale beyond that natural plateau normally means giving a piece of it away. How much of that is is up to the individual, but you will normally reach a point, and this is like I've got other clients who are still single operators that have far surpassed that in their industry. But more often than not, if you've reached that point and you've been at that point for a fairly long time, it's proof that something needs to change, and you need to inject something new, whether that be new ideas, new systems, new capital, new markets, new something. So
Mm,
to access those, you've either got to have a really strong balance sheet to go and spend, to reinvest into those new things to start lifting your revenue. If you don't have a strong balance sheet and you're looking to do those things, you're going to have to get capital by either debt, which is really risky, or you're going to have to look to take on not just passive investors, because passive investors aren't going to add any value to that. They're just going to give you some dollars and probably not going to give you the push that you need. You're probably going to look for someone or some organization to either partner with, JV with, or invest with to
mm.
add some additional additional scope, capability, etc., to push that product to the next level. That will be
Yeah, it's so interesting that it's a theme that, obviously you see a lot as well. And I think these sole owners will struggle very much to be able to give some of that equity away
it's really
to
hard.
to to make that step. We actually went through that journey ourselves, and so when we got to a point where we realized we needed more specific industry IP to build what we wanted to build, luckily we found the right business partner. But it's a very difficult decision to make. Let's talk a little bit, dive a little bit more into working capital, if you like. You still see examples in the tech space where partners or organizations are profitable, but they still run out of cash. They still run into issues.
It
Why
happens.
does that happen?
It's really that disconnect between P&L and cash flow. So your cash flow and your working capital is purely balance sheet based. The P&L has very little to do with it other than the number that falls out the bottom. So when we really get clients to look at their cash flows and their working capital, it's really a balance sheet exercise to go, are my debtors healthy? Are my creditors on time? Is my inventory healthy? Do I have anything that needs to be moved on? Am I going to run out of inventory of something very soon? In the tech, inventory is not a huge issue unless you're building something
Mm,
actually like
physical, yeah.
if you're Nvidia building
Yeah.
supercomputers, then you've got stock. But otherwise, if it's a SaaS or something intangible, then you don't have that problem. But still, if you've got debtor problems, you've got everyone's buying your product, but no one's paying for it. So you've got the crunch from the top side, which then usually leads into your creditors suffering as well, which means you get poorer terms in terms of what you're buying. You've got people on the phone taking away, and it's not just the cash crunch, it's also the mental crunch that you're constantly worried about which creditor is going to call me today, which person is going to knock on my door asking for money. So having really, really good understanding and systems to understand your cash flows and working capital, making sure that we're being paid on time for our services, our debtors are healthy, making
Mm,
sure we pay our creditors on time to make sure that they're happy and giving us good supply terms, making sure our taxes are on time, because that's always the thing that suffers. Usually people pay the ATO last and
yes. Yep.
go on
Guilty as charged.
and go on payment plans, but that's really dangerous now, especially the
Mm,
ATO has changed the laws around deductibility of general interest charges, which is a huge thing for a lot of businesses. They used to use the ATO as a bit of a bank,
mm,
but now that interest is no longer deductible, which means the 10 to 15% the ATO is charging is essentially credit card rates once they become
mm,
deductible. So it's really making sure that when we do those cash flow projections, we're really, really honest about what our debtor days are, what our creditor days are. Have we got all of our BAS payments, super payments, all of our income tax payments, all of that built in? When's the R&D refund going to hit? Because that's usually a big spike in our cash flow. And when we've got all that money in our bank account, we tend to get a bit spend happy, and we tend to
yes.
take some money off the table, or it all
Yeah.
gets reinvested really fast. And then we find ourselves in the same problem again. So yeah, being really accountable to that cash flow is really important as well, because it's no good having these really wonderful reports and models if you don't stick to them. So making sure you're accountable to them is really important too.
Yeah, I'm keen to talk about reported and tools in a moment, but before we do, just knowing that, some people listening to today's call don't have a finance background, or maybe it's the first time running a business, right? They might have the technical skills, but they've never started their own business before. Can we just take a moment just to explain the difference between cash flow, working capital?
So cash is just your top line bank account. That's something you can access straight away. It's instant. It can't be diluted in value. That's your cash, and it might be a term deposit. It might be your checking account. It's very rare, but some people have money invested in shares or crypto or things like that. But again, that has a risk profile and it can change in value. So not really cash. Working capital is a combination of your current assets minus your current liabilities, essentially. Your current assets are cash, inventory, debtors, and anything that can be readily converted into cash. So that's usually your current assets. Your current liabilities are your trade creditors, any loans that you need to repay within a year, all of your kind of current tax liabilities, super, payroll liabilities, etc. So when you take assets minus liabilities, it will give you a working capital number. It will give you a figure that falls out the bottom. And what we tend to tell clients as a bit of a rule of thumb, if we kind of had a cataclysmic event and say, for instance, you're in tech and you're a web-based business and you had a hack and the business went dark for days, weeks, whatever it's going to be. You should have enough working capital there to last 6 to 8 weeks, about 2 months.
Okay.
That should always be kind of sitting there as available cash to withstand shocks. And it doesn't have to be a cataclysmic event. It might just be an expense you didn't see coming. Something might break. You might need to pay a large bill you didn't see coming. It's really, and as I say, it's a rule of thumb. It might be more, it might be less, depending on the nature of the business. But we always try and have that baseline of available cash or working capital there to allow the business to run smoothly and absorb those shocks.
Working capital can be used as a competitive advantage, do you think?
Absolutely. So if you come across an opportunity and you have that working capital there or excess working capital, you can certainly
Mm.
use that to take advantage of an opportunity. Yeah, if something's come onto the market that you think is a really good idea or an option for your business, or you come across a new piece of tech or product that you think would augment yours really well, then having that kind of available cash flow there to take advantage of it is fantastic. Absolutely.
Yeah, that's awesome. One of the things I personally like to have in my business is really good visibility.
Yes.
I like to know what's happening. Now, I don't do a good job with that probably on the finance stuff. That's someone else in the organization takes care of that. But I love to see those reports. I love to be able to, digest that information. I've always found that very empowering in my corporate career. And now the founder of our own organization. Yeah, is there common dashboards or tools or resources that you recommend your clients use to be able to have that level of consistent visibility
Yeah,
in the business?
absolutely. So, kind of, you look at the drivers of working capital and available cash, and I'm just going to use the zero dashboard for example, because a lot of people are on the
Yep,
zero.
yep, we're
So,
on Xero.
yeah, you've obviously got your top left hand corner. You've usually got your main trading or bank account there. You can see your available cash balance. To the right hand side, you'd normally have your debtors, your debtors widget, your creditors widget. You'd probably have your payroll widget there as well. Kind of what's due in terms of super, wages, PAYG, etc. In a tech based business, they're usually your big three. You normally got people, and you've normally got your normal debtors and creditors. So, making sure that the data module is kind of highlighting anything that's becoming a problem. So getting outside of trading terms or beyond trading terms, so we can take action on those. Similarly with the trade creditors, making sure that's looking healthy and up to date. If there's anything that's looking like it's out of place, keeping an eye on those as well. And yeah, most importantly, the payroll side of things, because without happy staff, the whole thing falls apart pretty quick. So
Yeah.
it's one of the really important ones. And if you've got inventory, probably an inventory tool there as well, just to have a look at your highest value inventory items there and making sure they're looking within the right ratios is really important too.
So I'd love to move on to talk a little bit about capital expenditure, and I'll use the example inside our organisation. So I was very fortunate to have a wonderful corporate career, and that's given us a little bit of financial freedom in life, if you like. And so when we've started Channel Guru, we've funded through cash, and we have it in our documentation of our business with our business partner, that we'll be able to get some of that loan back, if you like, loan to the business back. But is there times where I should be using debt versus cash? Like, what are those decision points to be able to say where is the best place for me at this point in time to be able to finance
So
capex?
it really, there's a couple of different considerations, but the biggest consideration is the cost of capital. So
Okay.
the debt cost of capital, if you're depending on where you're borrowing from, if it's at home loan rates, you're talking in the maybe the high fives to a six. If you're in mezzanine land, you might be talking kind of 10 to 15s. And it's really that cost of capital question. If I deploy this capital, what return am I going to achieve on that capital? So if I deploy debt, am I going to achieve a return beyond what the cost of my debt is? Similarly, if I was going to deploy my cash, am I going to achieve a return that is better than if I was going to deploy debt and make money on the arbitrage? So that's usually the first question you're going to ask yourself. The second question is, if I'm using cash, do I have this cash available to go and invest in CapEx or something like that? Or am I dipping into funds that I've got earmarked for something else? Because if you might have a cash balance there, but based on our cash flow, it needs to be deployed down the
Mm,
track. Am I
yeah.
going to be able to get that cash back in time to meet my future requirements, or is that cash committed for an extended period of time? So am I able to have that cash deployed and locked up for a significant period of time without it impacting my business? That's the kind of other thing you need to be aware of. And then from the debt perspective, look, debt is healthy in a lot of businesses as long as your return on capital deployed is in excess of your cost of debt, then debt can be very healthy.
Okay. I'm going to ask a question that this is not financial advice to anyone listening to this conversation, but is there from in the debt kind of cash conversation, i- is there, am I avoiding risk with debt? So if I take debt and the company fails, am I still liable for that debt if it's a PTY Ltd business?
Banks are
Like,
pretty, banks are pretty smart these days. There are these things called director guarantees floating around. If you go to the bank and take on some debt, it's highly likely that they would cross secure against your home or other assets to cover themselves in the event of the business going into default. They would very, very rarely lend purely on the strength of your business or your balance sheet. They will always look for some kind of security, maybe 100, maybe 200 times the value of the loan in the event that this venture or this lending falls over. So if you can find a lender that's willing to lend to the PTY Limited company without some kind of bricks and mortar security or some other security or some kind of director guarantee that ties you individually to that debt, uh,
mm,
I'd be very surprised. They're usually pretty strong these days in cross collateralizing and locking up those debts to make sure that they're covered.
yeah, okay. Damn it! I thought there was a safe investment option I could convince the wife of. Um, so let's talk a little bit about inventory and something that I've got no personal experience in. But you mentioned it earlier, right? You mentioned NVIDIA, and if I'm an organization that is building widgets of
Yeah.
some sort, how do I? Again, I haven't operated in this space, but how do you provide advice on how I balance, I guess, how much volume of inventory I have on hand versus customer demand and, speed of delivery? Because
It's
that would
really
be really risky, I would say.
it's super risky, especially when you either got rapid technological change or
Mm,
fashions change really fast. So take the technological side of things, for instance, if you're building a piece of hardware for a computer, for instance, or something like that, and all of a sudden somebody comes out with a brand spanking new piece of tech that flips the industry on its head, and I'm sitting on a very, very large portfolio of parts that are now basically rendered obsolete overnight. What do I do with that? How do I repurpose that? Do I fire sale it? Do I scrap it? How can I realize
mm.
the most value that I can on that inventory before it becomes absolutely worthless? I need to take it to the tip. That's usually the first thing. And same thing with fashion. Like if you've got people that are either like clothing, furniture, thing kind of shoes, and anything that is heavily fashion based, fashions change extremely rapidly. So if you're buying certain colors or certain materials that all of a sudden are no longer fashionable, you
Mm,
might find yourself with an inventory list with stock that is now not going to be moving. It's essentially locked up money sitting in your balance sheet that you can't access until you sell it. And if it can't be turned into a product that customers want, what's our other options for moving that on for as many cents on the dollar that we can? So keeping an eye on your stock volumes, keeping an eye on how often or how rapidly we turn over stock. And it comes back when I was at uni, they always talked about the Japanese just-in-time inventory kind of model where you only order and receive as much as you can to satisfy your turnover. A bit harder these days, especially with the rise of, I suppose, Chinese manufacturing and Chinese ordering. You find, and now there's a lot of um, minimum order quantities and things like that that come out of these large manufacturing places that they will require you to buy a certain amount of a
mm.
of a component before they will ship it to you. And that MOQ might be more than you really wanted, but you sit there and think, what is the risk of not being able to sell it all versus carrying maybe slightly too much? So you have to
Okay.
weigh up those various pushes and pulls. Yeah.
Yeah, it's really interesting. It sounds like there's so much complexity in that, particularly if you've got offshore suppliers as well.
Which is
Um,
pretty pretty common these days. If you're in textiles, if you're in anything electronic, you're pretty much getting it from Southeast Asia. Australia doesn't really produce much of that stuff anymore, unless it's highly technical. Then there's a bit of that around, but anything that's made en masse, it's usually coming from Southeast Asia somewhere.
okay, interesting. Yeah, you mentioned earlier, James, you were talking about finance. Whilst I was trying to find loopholes to be able to raise capital for my business without any accountability, you mentioned home loans and director guarantees and extension for home loans and common interest rates. Is there any secret sauce to finding um, investment, for finding capital that is at lower interest rates?
Look, it's it's an interesting one because most bankers will try and work within their parameters to find you a loan that gives you obviously the rate you're looking for. And h- bricks and mortar home loans are always the lowest. You're never going to get any lower than a
Right.
than a
Okay.
resi- than a residential mortgage. So if you do go down that path and look to go and either get an equity release on your home or anything like that, the banks will normally ask, "What is this money going to be for?" That's usually the first thing they're going to say. And if you turn around and say, look, I'm going to go and pump it into my business, they're going to naturally move away from the home loan world and into more of the commercial financing side of things. So it's I don't want to tell you to lie to your bank, but it's a really hard one to do. And that's where a lot of times if people have offset accounts, they will dip into those because they can be accessed at any time. So and it also comes down to the length of time you wanted to borrow that money for. If it's short term, and let's say you had a bit of money in your offset account, I've seen clients dip into that, use it for something short term that they know is going to be put back at the end of the day. If it's longer term, then you're probably going to be in the realms of getting commercial finance, and the rates aren't that much more. I mean, it's only maybe going to be 100 basis points more than a home loan. It's not going to be double. It's just going to be more. So most of the time, clients will pay that extra 1% to do it through a commercial loan, have the preferential terms, and usually that 1% comes back through kind of either better. They usually, if you, the bank will normally bundle up your home loan and your commercial loan, and you probably get better terms across the two. There's other ways to skin the cat around that kind of stuff. So the best thing to do is, as most of the financial advisors always say, make sure you shop around, check with brokers, go direct to the bank, but just don't go to your existing bank. Go to a new.
Right. Okay.
It's true because
Interesting.
if I've got a home loan with CBA and I go down the road to NAB looking for a business loan, the first thing they're going to go
Yeah.
is who's your home loan with, and
Right.
you'll most likely get the home loan at a better rate. Plus,
Mhm.
they'll dangle a carrot for the business loan. So there there's usually some wins to be made out of going. If you're going to source new debt, you'll probably get a pretty good win out of going to a new bank. And usually, when your existing bank finds out you've gone to a new bank, you'll be amazed how quickly they start dropping rates.
Mhm. Yeah, it's something that my wife and I have always practiced. We've often swapped home loans companies, banks every couple of years,
Yeah,
or call them up and tell them, ask him for a payout figure on your loan. Don't even ask for a discount on your rate. Ask him for a payout figure, and all of a sudden they go, Why do you need that?" And yeah, use it as a way to screw all them down. And 9 times out of 10, you'll get a discount, even from your existing lender, just by making a 10-minute phone call. Saves you thousands of dollars. So, hey, look, James, I don't know what generation we're up to now. I don't know where X or Y or
things I've seen,
do we
Jam.
go back to do we
I've
go
seen,
back to A
I've
when
seen
we
TikTok are thrown around. Yeah,
you've seen
yeah,
so, but the expectations of employees continues to change. My last formal gig, if you like, was at Microsoft, and I had a range of individuals working for me, and certainly the expectations and the working style of some of the early in career people in my team were significantly different to behaviors I experienced with other generations. So we continue, and this will always be a change that we see. What kind of benefits are you seeing that, I guess, the younger generations or employees today are really looking for as they decide, organizations to work with?
yeah. So it's really interesting because obviously I see the new crops coming through as well, and there's certainly a different viewpoint on work, which I think is really healthy. I think the whole kind of work life balance paradigm that we've found ourselves in now, I think is really good. I think if you looked at even myself, like in my 20s and 30s versus my career now, the flexibility that I have, I've got young kids and things like that, and I really value that even as a partner. So I think it's really important to keep offering those things to staff. I think they're really incentivized by it, but it by itself, it's not enough. Obviously, the flexibility side of things is certainly across most organizations now. But what I've found is, especially in because this is from an accounting perspective, our organization is very much a relationships organization. We're very much a people organization.
Mm.
We thrive on the relationship with our clients. It's not so much the dollars that fall out the bottom. It's having those relationships and seeing your clients succeed is really what kind of gets you out of bed in the morning. So for staff, they really value that opportunity to develop relationships with clients as well. That's the main thing. And obviously, if depending on your industry, you might not have that opportunity. You might have limited opportunity. So it really comes down to kind of what's your contribution outside the dollars. That seems to be one of the major drivers for this generation. What am I contributing to overall, whether that be the organizational goal, whether that's a personal goal? It seems to be one of the big factors, and obviously pay and things like that are big factors. But pay is so transparent these days; it's very easy to know what the market is in terms of certain roles. Organizations know these numbers; they know where the market sits, and they will always pay at at market. It's really what you can offer outside of that, and coming from what I've seen, businesses, and especially in the startup world, businesses where you can offer some kind of potential upside or ownership or some kind of skin in the game for a business really keeps people incentivized. So now you're talking about employee share schemes and things like that. Not so much at kind of your big bank levels where they'd all get access to a share scheme. If you're in talking in the startup and the tech space, if you can really engage young talent, show them a pathway whereby they can contribute to obviously the organization and what they're creating for one. But number two, they can see that after a certain time horizon, they might participate in whatever exit or realization the founders are looking to also create. That's also a big motivator because then it's something that they can tangibly receive at the end of the day that will help their families and similar to you will give them some kind of financial freedom to allow them to pursue their next interests after that. So it's a number of different things. So it's it's really important. I see that a lot more, and you'll see that you've probably seen a lot in financial newspapers and whatnot. The rise of the kind of venture capitalists and private equity
Yeah.
businesses, they're all offering these kind of incentives to staff, to try and, I suppose, keep that human capital in the business, especially if they're valued,
Mm.
and a pathway, and offer them some of that financial freedom that you've experienced. So it's certainly a great motivator.
So I'm a little bit confused then. So that startup scenario, what's the difference between shares and equity? I mean, I know the difference between
Shares
shares
are
and equity.
shares are equity.
In the share, and so in that share program, the employee share program, it's basically offering equity inside the organization, earn equity over time.
So normally the conversation will be, a founder approaches us and say, "Look, we've got this key talent. We want to lock them in. We want them to be a part of this journey. We want to give them some skin in the game." Usually, the value of that skin in the game is beyond what that staff member can afford, for one, and two, the founders don't just want to give it away. They really want to, I suppose, still have control of the business and control of that exit at the end of the day. So normally what happens is you will establish what's called an ESS, or an employee share scheme, or it might be an ESOP, an employee share
Mhm,
options plan.
mhm,
In both of those models, essentially you are carving out a percentage of your total share base or equity base, putting that aside for the benefit of key staff. So there will be performance hurdles attached to those shares, whether that be revenue, whether that be EBITDA, whether that be valuation, whether that be, it could be anything. But it means that money, or that share allocation, is put aside. It still remains within control of the founders until the time of exit. But
mhm,
at the time of exit, that portion of shares will come out of, there's usually a vehicle we place it in to keep it protected. It comes out of that vehicle, goes into the sale, and then goes to the staff, so they have their realization on those shares, or equity, at the end of the day. So in the startup space, it's certainly a very attractive thing, because obviously the base is very low, the blue sky is very high. So it's certainly attractive, and for key talent, it's certainly something that is offered across most organizations.
mate, I could probably talk for, um, hour days and days and days about some of this stuff. I've learned so much, James, from today's conversation. But we do want to talk a little bit about an upcoming course that you have. So you're running a financial leadership course, I think in February sometime.
Yeah,
Can you
so
tell us a little bit about the target market, things you're gonna be
yeah,
covering?
the genesis of this came from essentially running kind of private education to certain clients. I had a client who had some children succeeding into the business, and wanted them to have a certain level of, I suppose, financial acumen, and some deeper learning in terms of how to analyze financial reports, and look at the business from a finance perspective. So I took them through a kind of 10-week course to kind of dig into. It was specific to their business. So we looked at that and we saw what they got out of it, and we thought this is probably something that we could offer to not just our clients, but the kind of startup space, and even the family business space in general. So we've developed this course to essentially try and give founders and business owners the tools to better understand their financial statements, from P&L, balance sheet, cash flow, and the components of those. And beyond that, looking at structuring, looking at business risk, looking at financing, looking at tech stacks, looking at basically everything that you would contemplate in running a business. We will have touch points on, and hopefully give people some tools to not necessarily answer those questions, but have enough knowledge to, if they can't answer the question themselves, know who to go to get the right answer. Whether that be your internal finance person, whether that be your accountant, whether that be your lawyer. Yeah, we want to be able to arm people with the right knowledge to either go and find it, to answer themselves, or to go and get the right person to answer it for them. That's the main aim of the game.
In our, community today and in our trusted network, there's a lot of startup founders, if you like. Some of them, a serial, entrepreneurs, if you like, and have done multiple apps. Some dabble in it as a side hustle. Other people may already have a mid-sized established tech organization, typically a TSP or MSP organization, and I'll go and start another project on the side. But there is all that sits in our community. But a lot of the partners in our community are MSPs. They are TSPs. Would they get value out of a course like this and better understanding? Because a lot of them are looking to expand. A lot of them are looking to exit. There is a lot of um, a different generation, if you like, of founders in the tech space that are now looking to exit the organizations. So is there richness that they're going to get? Is there things that they can be learning from this workshop
Absolutely.
as well?
So I suppose when you're in that TSP and MSP kind of level, I've still found most people in that space and at that level have, I suppose, cursory knowledge of what's happening financially with the business. They'll be able to kind of look at their profit and loss and look at their balance sheet, and the numbers will look kind of within expectations. Usually it'll be bubbling along as they kind of have gotten used to over time. But I think with this course and armed with a bit of extra knowledge, they'll be motivated to ask a bit more trying questions of the people that are providing them with this data. So
Mm.
rather than just looking at their trade debtors and going, "Oh, that number looks good," it looks like it's hasn't changed since last quarter or last 6 months. When you dig into the underlying reporting, you might find that one of those debtors has gone really, really bad, but it's just been hidden by other debtors that have been put in its place. So the top line figures that you see in a P&L and balance sheet, while all well and good, unless you understand the mechanics of how that number has come to be, you always run the risk of being surprised by something down the track. So we will speak in a far more, not a super granular fashion, but we will certainly dig a bit further into what makes up certain numbers on your P&L and balance sheet to make sure that when you look at any of them, you know what questions I need to ask to find out, is it healthy, is it not healthy? How is that linked to other components of my balance sheet? And overall, am I satisfied with the numbers I've been presented with, whether that's from an internal finance person or whether that's from your accountant? And do I need to ask any questions around any of these figures? And I think once you understand the mechanics of certain components of your financial statements, it really empowers you to, I suppose, dig into it and have some confidence in it at the end of the day.
Yeah, it's we earlier in the conversation, James, we talked about this common scenario where a lot of organizations in the tech space get to that $3 to $5 billion revenues, and then they cap out of growth, and
Mm.
they've all got ambition to get to 10, but they don't know how to. One of the key observations that we make, a driver for that, is leaders struggle to understand how to ask the right questions, to delegate and hold their leaders accountable inside their organization. And so a lot of that responsibility falls back on the owner of the organization, who is very busy and may not have the skill sets around finance. And so a course like this, and it would really help, to your point, help empower them to be more informed,
Yes.
to ask the right questions at the right time, right? And to maybe seeking the right information, and to drive that accountability inside the organization. James, thank you so much, mate. It's been really interesting. I've learned a lot throughout today's conversation, and we're going to really encourage our members to consider popping along to your course. I think it's a 10-week course. Did you say it's?
Yeah. Yeah. It's over a half day. We didn't want to overburden people with too much
Mm.
in one day. So it's a series of half day courses where we touch on 4 units per day. And they're really tailored to be interactive. We've got kind of very high level theory at the start, and then we put that theory into practice by testing it against hypotheticals, etc. So it's really interactive, and it's there to promote not just learning, but also conversation between your peers and to share stories about what's happening in your own businesses. So we think it's going to be really good.
Awesome, James. Well, thank you so much for your time, mate, and look forward to hearing feedback from the course.
Pleasure. Sounds good. Thanks for
Cheers,
talking.
mate. Take care. Bye.
Bye.